Welcome to the weekly update, where we'll go over the action in the market for July 5th through the 8th, and then we'll see how things look for the week of July 11th through the 15th. And we were up on the week, and we're starting to see some real positive things on the daily charts. We're not seeing it yet as much on the price action that's happening, a little bit, but things are starting to look a little bit better, and I'll bring up some charts to show you that. Now, on the weekly charts, we're still looking pretty negative overall. So let's go back and talk about the week session. The S&P was up 1.9% for the week, which sure beats what's been happening. So that's kind of a good start to the second half of 2022. You have a lot of people that are really exhausted right now because they just went through 6 months of a very frustrating market environment. And you also have summer, so people are taking some time off. And you combine those things together, and we're seeing volume really drop off as well. Well, let's see. Can the second half be any better? This kind of started on Tuesday, but really you should drop back to the Friday before the 4th of July, where we opened down and then we saw a nice recovery for the rest of the day. We saw pretty much the same thing on Tuesday, where prices really fell, and then there was a recovery going back to the lows from the previous week. And this led to a rebound that we saw in this past week. The technical picture is improving and starting to turn positive on the daily charts. Our oscillators are positive. We were able to get back above the 20-period moving average. A lot of our other indicators are positive right now. They're not really showing up on the weekly charts, but they are starting to show on the daily charts. This past week, we had the June FOMC minutes that were released, but after reading through those, nothing really new was said. And the stance that the Fed has right now is that inflation is the big concern. And so that's why they're raising interest rates. They want to get inflation under control and then possibly go back later and worry about the economy. Whether you agree or disagree, that's the stance that they've taken. And we call that more of a hawkish stance. That means they're willing to raise interest rates. When they get to the point where they're starting to lower interest rates, we call that a dovish stance. And interest rates over the past week also rose. One thing that's really interesting is the dollar, especially the US dollar index. It is really strong. It was down a little bit on Friday, but it's just been going really up in a big way. In fact, it's surpassed the euro. Those are the two main currencies that are going back and forth right now. The third major currency in the world is the Japanese yen, and that's been seeing a lot of weakness lately as well. And of course, on Friday, they had their former prime minister assassinated. But beside that, on an economic standpoint, Japan could potentially really have some problems in the future. So for the week, we ended up being up 1.9%. Volume was below average, which should not be a real surprise. The technicals are still pretty negative when we're looking at the weekly charts. Although we're seeing some improvement on the daily charts, we have inflation and interest rates. That's the real focus right now. What's going to happen? Is inflation topping out and starting to come down? There are some charts that we have and some information that we have to suggest that that might be happening, but we don't really know for sure. And what's going to happen with interest rates? Are they going to continue to go up? Yeah, that seems to be very likely. But at what point will they start to come down? Of course, we have a whole list of different geopolitical concerns with Russia, Ukraine, the supply chain issues. And my understanding is over the weekend that China's starting to lock some things down again. They found some COVID cases after loosening their lockdowns. Now they're going through the process of, they want to have zero COVID in China, no matter what that does to the supply chain affecting folks in the US. Oil, it actually dropped a little bit below 100 there for a while, but then went back above. We've got Fed speak and policy. That happened this past week with the FOMC meeting minutes being released. Earnings are pretty light right now, but we just take those on a case-by-case basis. And then recession fears. That's the big debate going back and forth as well. The focal point is inflation and interest rates, but are we going to go into a recession? You have folks that are completely convinced that we're probably already in a recession right now. And if we're not in one now, we're going to go into one. You have other folks saying, not so much. There's the employment situation is still really good right now. And usually when we have a good employment environment, we don't necessarily go into a recession, or if we do, it's not very bad. The condition of our trend is still negative and the ADX continues to get stronger. And I'll show you charts. So here is the week. And actually we should go back to the previous Friday, July 1st, where we gapped down at the open, went all the way to the low, and then spent the rest of the day really recovering. The day wasn't all that big of a deal on the daily charts, but this showed some real strength. And we're starting to see some rotation going from the value sectors into the growth sectors. And I'll have some charts to show you that. And I have some other possible positive scenarios that I'll go through near the end of the video. Well, then on Tuesday, we gapped lower again. And this was almost a carbon copy where we gapped and then built a base here and then spent the rest of the day going back up. We weren't up all that much, less than 1%, but it was still less than 1 point, I should say, less than 1 percentage point. But this was pretty positive overall. Then on Wednesday, we were kind of flat. We drifted down. This is when the FOMC meeting minutes were released. And then we gyrated a little bit when the minutes came out. And then we ended up going higher. Thursday also saw a gap higher, and we closed up on the day, where Friday was kind of choppy and just wavered all over the place. We're actually down a little bit on Friday. The Dow ended up being up 0.8% for the week, the NASDAQ, and that's kind of the area that we're watching right now for leadership. That's growth. And so they were up 4.6%, and the NASDAQ 100 is another index that we watch. The S&P 500, as I said, was up 1.9%, and the small caps, or Russell, they're lagging a bit behind, but they were still up 2.4%. We'd like to see some more growth, or at least price action going up in the small caps, but we're really not seeing that right now. Here is looking at the different indexes over the last 4 trading days, because we had the shortened week, where the NASDAQ did the best. The NASDAQ 100 did the best, followed by the NASDAQ. Here's the S&P here in pink. And pretty much you can see where all of the indexes ended up being up, with small caps only up 1/3%. We'd like to see that doing a little bit better, but it's just not happening yet. This is looking at all of the different indexes going back to the beginning of the year. This is a new chart that I had just started showing in the daily videos. Well, here's the weekly version. And it just shows over on the right-hand side where the NASDAQ 100 and the NASDAQ, they've been down the most. And the Dow has really been the index that's held up. Even though it's down over 13%, it's better than some of the other indexes have been doing. Looking at the sectors for the week, discretionary did very well, and tech and communication. These are the ones that have just been getting hammered. Well, on a weekly basis, they did the best overall. And the areas that did the weakest were materials, energy, and utilities. And then staples were also down, but not as much. But these are more the value areas. And so could we be seeing this rotation scenario starting to play out from value into growth? And that's where you get the real rise in the market. Here are just how the sectors performed over the past week. All of them were up except real estate. They were down. Then looking at our current market valuation, we're still fairly valued. I only have one chart. Well, here's the historical chart of all of their charts together, showing that we're on a fairly valued point because we dropped down below this yellow dashed line. But this is the one chart showing where the S&P is according to its historical average. And we're still a little bit pricey. If we drop down below this yellow dash line, then it would become fairly valued. So we're pretty far away from this other dash line, which is the historical average. And this acts kind of like a rubber band. It can take a long time for this to to play out. We've been above this quite a bit for years now, but we're starting to come back down and get a little closer as far as the valuation is concerned. Looking at sentiment after Friday's session, we're not in extreme fear territory, but we still are showing a lot of fear. And here's the historical chart, how we came up out of the 25 range, or at least below 25. And then looking at the spread between the risky loans, those would be like junk bonds and not collateralized loans and things like that, against the treasury loans. And when this really spikes up, this has been a time of trouble. These grayed areas are times that we had a recession. Well, it was spiking up, but over the past week, it actually came down slightly. Here's a chart from IsabelNet. This is looking at the Dow going back to the early 70s and how the Fed funds and the Dow went really hand in hand with each other, and just all the different historical things that were going on during that time. I find this very interesting, but I won't take the time to really read through these. But it just shows the green, not the green, the blue line here, the lighter blue line. This is the Fed funds rate, and it's on an inverted scale. So it's as they're going up, that means the S&P or the Dow in this case is going down. But it just shows the real strong correlation between the two. So that's why we keep an eye on the Fed funds. This is looking at the probability of a recession, and they're not really giving it all that much. When we really spike up, then a lot of times a recession is either underway or it happens not too long after that. Well, right now, they're projecting it to go even lower. So this chart, according to the yield curve, even though we have some parts that are inverted, it's not necessarily telling us that a recession is going to happen. Looking at the outflows from the financial sector, they're still negative and dropping off just a little bit. You would think in a rising interest rate environment, the financials like the banks and things like that would do better. But the sector itself has really suffered. And so people are taking their money out of that sector. Here's the financial conditions and the S&P 500 just showing the real strong correlation. Kind of this purple line here, these are the financial conditions. When they're going up, the S&P is going up. Well, it's really starting to come down right now. So this could suggest that we might see more weakness ahead. Then looking at the tech sector, we're actually seeing some money coming back in, and this could help our sector rotation scenario by seeing where the 4-week moving average has actually gone positive. So people are starting to put their money back into techs, which the tech sector, which is growth. This is looking at employment, showing the all employees, that's the red line here. And then you have the GDP, which is the kind of the black line here. Well, this is the temporary help. And these are jobs that people can get that might be full-time, but yet may not be permanent or may develop into a permanent situation. When this really drops, that's when we tend to see a recession. Well, look at where we're at right now. This is pretty positive. So this is suggesting on an employment basis that maybe we're not going to head into a recession. So you can see there's cases that you can make for either side of this right now. This is the risk appetite indicator. When this drops below the dash line, it just means that folks don't want to take a lot of risk right now. And there's also a momentum indicator on here as well. And people are kind of averse to the stock market because they've been getting burned. Then this is a thing called the MOVE index, and where we have the VIX that measures volatility of stocks. Well, the MOVE index measures the volatility of bonds. And this is really, really high right now. And bonds have just been going all over the place, crazy, specifically going down. And this is where we're at as of July 2022. And other times, if you look back, this sometimes marked where there was some kind of big movement in the market around that time. Now, looking at the RightX bear bull ratio, it did go up slightly, but we're not necessarily extreme and we're not necessarily positive extreme either. We're kind of more in the middle with a leaning towards being more bearish right now. The latest survey from AAII shows that individual investors are extremely negative, and that could be positive for the market. When you have a whole crowd of folks that tend to follow what's going on instead of seeing what's happening before it happens, they a lot of times will arrive late to the party. And that makes sense. People have jobs, people have things that they have to do, and investing might just be one part of their overall project or something that they do as a part of their life, where you have the financial professionals who are in this all the time and they can see things as they're developing. So it's not really a surprise that we're seeing sentiment really negative right now. The VIX actually dropped over the last week, both on the line chart and on the bar chart. The Ulcer Index, this is actually more realistic on the weekly chart. We're showing no fear at all on the daily chart. It's dropped below the weekly, the moving average, where here we're seeing it come down a little bit, but fear is still pretty high. So this lines up more with some of the other sentiment gauges that we're looking at. This is what are the financial conditions of the US. We are seeing this really start to go up, but it's still below the black line. It's not really a concern until it goes above this black line. Could it turn back down? Yes. Could it shoot even higher? Yes. We just don't know what's going to happen yet. Here are the active asset managers, and they're still pretty pessimistic on things. They had gotten really extreme negative and then bounced back up. Well, when we had the down week a week ago, they also trailed off a little bit as well. Copper is something that we're really watching because it tends to really tell what's happening in the economy. When copper is going up, that usually means the economy is getting better. When it's going down, that means we're having some problems. Well, copper has really been suffering lately, and it really dropped over the previous couple of weeks. Some scenarios, and these are daily charts just to keep an eye on. And I do this in my daily videos, but not all of you watch those. So I just want to make these available to you, where we had a spike up in the VIX, and that's really been dropping off. But if you look at other times when we had a spike in the VIX, that often marked a low in the S&P. We're also looking at a thing called sector rotation, where near the end of 2021, the smart money was getting out of growth, and that's these red lines right here. They were getting out of growth and going into value. That's why you see this go down as the S&P is going up. That's a negative divergence. Well, a few weeks ago, we started to see a positive divergence where we're making a lower low in the S&P, but we're making a higher low in some of the growth areas, like the QQQs to the S&P ratio. Also, discretionary is starting to move up, and the large cap growth against large cap value, it's starting to go up as well. And this has been improving. Now, this is a daily chart right now, but we're starting to see a continuation of that rotation going on, and that could really bode well for the markets. Here's another chart showing large, mid, and small cap growth versus value. They are also going up overall. Looking at valuation, according to the Shiller PE ratio, we're still very overvalued. We're at 30.13, where the mean and the median are anywhere from 16 to 17. So this shows the markets are expensive still. Now that looks at a trailing 12 months and then an average of inflation over a 10-year period. Here's a blog post by FactSet that just says the S&P 500 is likely to report earnings growth between 9 and 12% during the second quarter. That's when earnings season gets up. And it's gone down quite a bit, but are these companies going to meet the expectations? But this just shows over the last year or so how things have really fallen. We don't have a dark bar here yet because that's the actual number that came out. But that's why you're seeing some real problems in the market right now. Ultimately, it goes through to earnings. Here's another post from FactSet just showing that the S&P negative EPS guidance, it's above average, but it's not at peak levels. Way over on the right, it's just showing how a lot of companies are revising things down, if not actually negative, but it's not necessarily any higher than what it's been before. Here's an update on our earnings estimates put out by Morgan Stanley. They're usually below the rest of the crowd, and I can't see where it's really changed all that much from the previous week. Here's the St. Louis Fed real GDP nowcast. They're forecasting the GDP will be positive. But if we look at the next chart, the GDP now put out by the Atlanta Fed, they're suggesting the GDP will be negative. As far as Fed Watch, there's a 92.4% chance that at the next meeting at the end of July, that we will be at 2.25 to 2.5 for the Fed funds rate, where we're at 1.5 to 1 3/4 right now. So this would be another 75 basis points or 3/4 of a point move. Then at the September meeting, so far they're thinking that we'll be at 2 3/4 to 3. And that's where a lot of folks have Fed funds topping out, is at 3%. Here's the Fed balance sheet showing just a little bit of a decrease in the latest version that I was able to get, because the Fed is supposed to be quantitative tapering now, getting rid of all the bonds that they were buying during quantitative easing. And that fueled a lot for the stock market. Looking at breadth, we declined a little bit based on price and volume over the previous week. We're declining a little bit with our advanced decline ratio, but we're still above 0. So it's still positive, but we did decline. Looking at the new highs, new lows, this is where we're getting some hope from, not only on the daily charts, but on the weekly chart, where the 4-week moving average of new highs and new lows is going up, and the 10-week moving average is going up as well, but it's still below 0 on the 10-week. Accumulation distribution is still negative. We're below the moving average, but we are going up slightly. Looking at the trend, this is what I say, where we're in a negative trend and it's strengthening, because this dark line, the black one here, it is going up and has not rolled over yet. Even though we saw a decrease in selling, we also saw a decrease in buying over the last week. So we're in a strong downtrend. The Arun is turning up just slightly when you look at the oscillator, where selling pressure decreased a little bit, but buying power is also decreasing. The mass index has not generated a signal. It won't until we drop below this red dashed line. Looking at some long-term charts, Decision Point had some changes. A week ago, their PMO signal on a short-term basis switched to positive. The trend model, as of Friday, switched to positive, but intermediate and long-term were neutral with their trend model, but were negative with their intermediate and longer-term trends. Here's our daily pivot, or actually I should say weekly pivot, where we're below S1 right now for the month of July. We've been able to recapture some pivot points on the daily charts, but we still have to recapture them on the weekly charts for them to start looking better. And down at the bottom, we can see where volume just really tapered off over the last week. We're well below the 50-period moving average. Our long-term trend, we have a death cross, and we're below the moving averages. And you're going to hear that a lot in this video, because it takes longer for the weekly charts to improve. Our BPI is showing some improvement. It was giving us an extreme negative reading and has bounced up out of that. And that could be positive, but the BPI is still negative until we cross above 50. The Chaikin oscillator is also showing in advance. And the Chaikin money flow, it's still negative, but showing some improvement. The Force Index, also negative, but showing improvement. The McClellan oscillator, it's still above 0, so that's positive, and we turned up slightly, so that is positive too. The summation index based on price and volume, even though they're below 0, are starting to go up. All of our oscillators continue to be down. Now on our daily chart, all of our oscillators are positive. And I've expressed my feeling on using oscillators on weekly charts. I just don't think that they're as valuable, because you would have missed a lot of the move in 2020 and 2021 if you had been following all of these oscillators, because they were giving negative signals. And part of that is because of how they're calculated. As price goes up, there are higher prices that are being used in the calculation of the indicator, so it can't help but roll over. Looking at the PMO, it's still negative overall. What I look at more are these bottom two areas where we're showing a bit of a bounce based on price and volume, also, although we're still negative. The PMOs that are rising, we're starting to get extreme positive, and that could be helpful. The buy signals are increasing, and we're seeing those PMOs above zero starting to rise. So internally, we're seeing some strength. It's just not really showing up in some of our other indicators or really on the price charts yet. The RSI turned up slightly. Special K is still positive and rolling over. It takes a lot for this thing to move, even on the daily charts. The Swinlin trading oscillator, it's going up based on price and volume. And that's actually been leading the way on the daily charts. We'll have to see, can it lead the way on the weekly charts as well? The Stoke RSI crossed just above 0.5, which is the midway point, so it's slightly positive. And the Williams percent R, it's not positive, but it is bouncing up. The Vortex, it's still showing a gain in selling and a loss in buying, where on the daily chart, we've switched to positive. This one is still decidedly negative. The ultimate oscillator is also slightly negative because it's below 50, but it is advancing. The money flow indicator also slightly negative, but it is advancing. The Bollinger Bands are going up after giving an extreme reading a few weeks back. So you can see some improvement here, but here the KST, it's still rolling over. The PPO turning up slightly, but it's still negative. The rate of change going back 1 week is positive because we're above this dashed line. Going back 50 weeks after giving an extreme negative reading is bouncing up slightly, but not all that much. The copy curve, where we're dealing with a signal on the daily charts, we're not getting a signal right now. It needs to really turn up for a signal to be generated. Looking at the weekly chart, we're still above the 38.2% retracement, and that could act as support if we do fall lower. We also have the 200-week moving average right about at the 50% retracement. Looking at the different charts, Heiken Ashi is still negative on the weekly chart. The Kegi is still negative. The Renko is negative. Ease of movement, it's showing some decline right now. The point and figure, it actually put in a couple of new X's, but we don't have a signal that's been generated yet. The three-line break is still negative. So we're not seeing it in price, but we're seeing it under the surface, some improvement. The elder system for the SPX is still neutral, and our SAR continues to be negative because the dots are on top. Looking at the broad market, here's just a look at the S&P, the mid caps, and the small caps with no indicators on them, just to show how they really move in tandem. We're not seeing really any divergences now. It would be nice if we could see the small caps doing a little bit better, as well as the mid caps, where you can see the S&P itself is ticking a little bit higher. The all stocks, they bounced up in the previous week, but we're still negative overall. Same thing with the mid caps. We're in a downtrend. Small caps are in a downtrend. The Dow downtrend. NASDAQ still in a downtrend, even though it's bouncing up and kind of leading the way currently for a potential recovery, if that is what will happen. The NASDAQ 100 is also still negative. NYSE and the Wilshire are both negative. The FANG stocks, they were up almost 6% for the week, but we're just dealing with the lower end of a moving average after being in a downtrend. ARK had a good week, up 13.5%, but still has a long way to go. The software companies are also in a downtrend, even though they were up slightly for the week. Here's Dow theory. Again, we're looking for divergences here, where utilities had been doing quite well and then saw some real weakness. Well, now they're coming back and starting to do a little bit better. Looking at the broad market, the CRB is really starting to go down on the weekly chart, but we're still in an overall uptrend. Gold is really just having a difficult time. You would think in a rising interest rate, rising inflation environment, the gold would have just really shot up. Well, it hasn't. It's either gone sideways or gone down. And the same thing with silver. It's really been getting hurt. And we just have a recent death cross here as price continues to fall. Oil, it dropped below 100 there for a little while this past week, but then closed above 100 at 104.79. Here's the dollar, which really has been doing about the best. It's really been going up. Now, it doesn't mean that this is a great currency. It's not backed by anything anymore. It just means when you compare it to the Japanese yen and the euro, people are seeing more hope in the dollar right now than they are in the other currencies. The dollar will probably have its day when it goes in the toilet, but at least it's not happening right now. This could be adding to some of the headwinds for stocks because they like a cheaper dollar for imports and exports and for conversion rates. It makes their books look a little bit better. So if stocks really are going to go higher, we probably need to see the dollar start to retrace. Looking at bonds, we've been in a downtrend with the bond ETF, and the 10-year yield after going above this high that we saw has really come back down, but the 10-year yield has bounced back up above 3% in the last week. We're seeing on this chart, all the yields really bunched together, and that's what you see around times of a recession or a potential recession. But we did climb in interest rates. Here's the international look showing that the US, the UK, and Germany, their rates are really going up, where Japan is staying much lower. They're in a little bit different situation, and they have a lot of US bonds, and they're having some real trouble. And if it gets to the point where they need to sell those bonds, because after the Fed, Japan is number 2. A lot of people think it's China, but Japan actually owns more US treasuries than any other country. And if they have to sell those bonds, that means when they're selling, that's going to push the price of bonds down and interest rates up. So that's something we just want to watch. Looking at our relative studies, bonds in the S&P shows where bonds could be starting to break out, but they did decline in the past week. We might be seeing a golden cross here on this chart. Looking at the stock bond ratio, it shot back up after having some recent weakness. And here's our intermarket analysis chart. Oil, which really suffered in the previous week, gained a lot of that back in this last week. And then you have the dollar, which is the green line. Gold has now turned negative since the beginning of the year, where stocks and bonds continue to be negative. The gold to the US dollar ratio, since gold has been going down and the dollar's been going up, that's why we're seeing this ratio really dropping off. And gold to the S&P, the S&P has been holding up or not going down as much as gold. So we're seeing this start to really break down, but gold is still in an overall uptrend with the ratio. Are we starting to see a switch? And then low volatility. These are the stocks that folks get into when we're having trouble in the markets. We're seeing that they're still in an overall uptrend, but over this past week, we saw a real drop. Here's the growth to value ratio, which is showing a little bit of improvement, but we're still in an overall downtrend. Here's the NASDAQ 100, the real growth area, compared to the S&P, where it's bouncing up in the past week. The S&P 100, which are growth stocks, still in a downtrend, but showing some improvement. Discretionary, the things that you would like to have, against staples, the things you have to have, they're kind of still in a downtrend with discretionary. Energy, which has been the #1 sector for 2022 against tech, it's really been in a strong uptrend, but showing some recent weakness. Here's some of our possible positive scenarios, and I'm just bringing this up because a lot of you don't watch the daily videos, where here is the percent of S&P 500 stocks that are above their 200-day moving average. We have had extreme negative readings, and if you look in the past, when that has happened, that has often marked a low in the S&P. Well, we didn't get quite extreme. We got back to the extreme where we were in 2018 with the Christmas Eve meltdown that we saw. And then we saw a real nice rise up out of that. Well, we're coming back out of this reading right now. Can we see that follow through into price? Here are stocks above their 50-period moving average, giving you an extreme negative reading and now bouncing up. Here it is for the mid caps. So we're seeing some confirmation, and also with the small caps after an extreme reading. Here's a little different look where we have a 10-day average of the S&P 500 highs and lows. They gave us an extreme negative reading, and now it's starting to bounce back up. And again, compare it to the chart above, and you can see many times, not always right on the same day or the same week, but a lot of times this marked a low in the market. Here's another look, looking at a 5-period moving average of all of the highs and lows for the American Stock Exchange, the NASDAQ, and the New York Stock Exchange together. We gave an extreme reading, bounced up, came back down, gave another extreme reading, and now we're coming back up out of that. So this is much more broad-based. Here's looking at our staples, where we were looking at this spike for a long time. Well, it fell back down. We came up, we matched the spike, and now it's falling back down. And when we see a staple spike in the ratio to the S&P, again, look at the times when this often marked a low in the S&P 500. So what's our outlook then for the upcoming week? We have on Wednesday, we're going to get a slew of inflation data this week. So things could really be a lot clearer a week from now. But on Wednesday, we have the CPI. That's the biggie. That's what so much is hinging on right now. Is inflation going to come down? Is it going to be up? Is it going to be unchanged? We'll just have to see how that comes out. Then on Thursday, we have PPI, which is the producer price index. That's looking at inflation on a more industrial level. And we also have jobless claims. And then on Friday, we have retail sales, which is a big part of the US economy. We have industrial production and capacity utilization. I know that Alan Greenspan really liked to use these indicators. I'm not as sure about the current Fed, if they use them as much. Then we have consumer sentiment. Are people going to be unhappy? Are they going to get happier? Are we going to see some improvement here? The last time we had this reading, it's the lowest that they've ever had since they've been doing the survey since about 1980. Are we going to see things improve? So we're watching the technicals, which on the weekly charts are still negative, but we're seeing some improvement on the daily charts. We still have all of the things that I mentioned at the beginning: inflation and interest rates, a lot of geopolitical concerns, Russia, Ukraine, the supply chain issues, oil, any Fed speak that we may get, especially with Chairperson Powell. If he comes out and makes a speech or does an interview, we'll be watching that really closely. Earnings are kind of light right now, but there might be a few that are released. We have the situation in Japan with the bonds that I was talking about, and then margin calls. If we continue to fall, a lot of people use margin to get greater returns. Well, they have to pay all that back. And if we start to fall, they may have to liquidate their position whether they want to or not. So that could feed into things going lower. So our scenarios to go down from here, and this is based on the daily charts, all of the things that I just mentioned, these are some pretty significant headwinds. And are they going to influence the markets and push things lower? But our technicals, at least on the daily charts, are starting to look actually positive. And then to go up, and I have this in yellow because it's more of a caution thing, we are seeing the charts improve. We're not really seeing it a lot yet based on price, but under the surface, we're seeing a lot of improvement. Can that hold up? Or is that going to fall apart? Because we've seen a lot of positive setups in 2022, only to have them fizzle out very quickly. Is this time going to be different? And then there's a real disbelief right now that the market can even go higher. You look at YouTube and you look at headlines, and everybody's pretty much telling you that the market's going to go down from here. Well, when you start to see all of that, that's when we start looking in the other direction. But it may not be pleasant for a while. And then we have our possible positive scenarios and our sector rotation. Those are potentially turning things more positive. Our technicals are still pretty much negative. We regained the 20-period moving average on the daily charts, but we're still looking pretty negative overall on the weekly charts. we're not neutral right now because we're going much higher with the ADX. So thank you. Have a wonderful week. Please feel free to check out some of the daily videos because I update a lot of the things that I talked about in every video. I may be cutting back on those a little bit because I need some time to prepare some of the coursework and the other materials that I have available as part of the program. But please watch for the other videos, and I hope they will be helpful to you.